Hey, what's up everybody? Welcome back to my channel. And for those of you that are new to my channel, welcome to my channel. Basically, my name is Peter and this is my family channel. Most of the time it's mine. I'm a mortgage banker and a vending machine operator, and I just talk about certain different topics weekly. I try to do like one or maybe even two videos a week. And today I'm going to talk about credit scores and how it affects your interest rates. Well, as everybody knows, this is pretty much a no-brainer. The higher your credit score, the better your interest rate. Okay, and you know, I want to talk about this because a lot of people, you know, they always think that, hey, I gotta wait till my scores are higher before I can refinance or buy a home. Well, you gotta, that's true in a sense, but what you gotta do is really take a look at what the market is doing versus where your credit is, right? And because I will give you a perfect example. I have a client right now that said exactly that. He's got a 680 credit score and he's trying to lower his interest rate. Today, the interest rates are really good. I mean, they're still really good, okay? I mean, it's not the same as it was in 2016, but needless to say, it's still really low. It's really good. It's still in your guys' favor, okay? We looked at his credits report and we looked at what he could do to raise that 680 to like a 720, okay? The best thing to do is really analyze everything. One of the biggest things that he could do is actually pay off his debt. I mean, he's been paying his bills on time. Everything's up to date. You know, he is a seasoned credit holder, consumer. And so basically, one of the biggest problems he had with his credit scores, that's why it's keeping it at 680, which is, don't get me wrong, it's still a great score, is his high balances. He has high balances on his credit cards. And, you know, I've spoke about this before in previous videos, but just to give you guys a snapshot here, you want to keep your credit balances at or below 30% of your available credit. So to make mathematical, you know, to make it mathematically sound, if you have $1,000 credit limit, you want to keep your credit, your available credit, your balances below 30%. So that means if your credit limit is $1,000, keep your balance at or below $300. Okay, so now that we have that set aside, that was his problem. He had like $10,000 credit limit and he owes about $8,000 or $9,000. Even though he's paying them off on time, his balances are high. Well, I asked him, I'm like, hey, do you have money to pay off those credit cards? And the answer was no. Okay, but he had enough room to be able to lower his payments. So I said, hey, why don't we do this? Why don't we take a look at your scenario, and after reviewing everything, you know, it would have been beneficial for him to actually buy his rate down. And so basically, if you buy your rate to, like, you know, maybe pay like a point to buy the rate down, this is not a charge of us loan officers charging them so we can make money. This is to buy the interest rate down. It's also called prepaid interest. You know, by him paying that extra point, it comes out to be as if he had like a 700 or a 720 FICO score. And at that point, it made sense because he didn't have enough money to pay off his credit cards, but he had enough so that he could have what they call a no cash out loan and buy the rate down and be able to lower his payments $300, $400 a month. So that right there sounded great, right? So these are things that you want to take a look at so that, you know, your payments could make sense in terms of dropping your payments on a monthly basis, okay? Because a lot of people go, oh, you know, I'm going to wait till the rates drop, or I'm going to wait till my credit score goes up. You want to take a look and do all your due diligence to see what can actually raise your credit score. Because, for example, if you have like a 660 credit score, but your balances are below 30%, and the only reason why you're at 660 is because of your credit inquiries, it's going to take a while for you to raise your credit score. if you have high balances and you have the means to be able to pay those down below 30%, like I'm talking, you have money in the bank to pay those down, by all means, go ahead and wait 1 month, because it could be worth it. I've seen people raise their score from 640 to a 720 in 1 month just by paying down their debts. So if you fall in that bucket where you have the money to pay down your debt to 30% or below your available credit, go ahead and wait, because it would be worth it. But if you're one of those people that just has new credit, or you have way too many inquiries, then it might be better for you to actually pay down your rate, or pay a discount point to get the rate that you want. Okay, at the end of the day, all of this will make sense, and you'll feel a lot better by you doing your due diligence. Always do your due diligence, because you guys, a house is one of the biggest, if not the biggest investment that every person would actually make in their lifetime. You know, so you want to do your due diligence, and you don't want to have to be, you know, refinancing every year, you know, just so you can catch up with your payments, or just so you can get the lower payments. I mean, I'm not talking about if the market crashes and all of a sudden the rates drop like 1-2%, then that could be, you know, that would be a justified way to refinance. But if you're trying to raise your credit score and then, you know, trying to refinance and catching up with the market, who knows? Think about this, okay? If the market goes up a tad bit, it kind of washes you raising your credit score a tad bit. Does that make sense? So if you have a 660 right now, and the rates are, let's say, 4.25 on a 30-year fix with that rate, with that credit score right now, if the market goes up a little bit and your credit score goes up a little bit, you're still practically going to get a 4.25. Always track what the rates are doing, what the market is doing, versus where your credit is right now. Because keep in mind also, a discount point could be a tax deduction as well. Okay, in many instances it is, depending on where you're at. Talk to your tax guy. But a discount point, any fees you pay at closing costs and all that stuff could be a tax deduction. So don't limit yourself into the I'm gonna wait, because you might be waiting for a very long time, and you could be throwing thousands and thousands of dollars away by throwing that money out. Now think about this also. If a discount point costs you $3,500, but your net savings is around $300 a month, that's $3,600 a year. $3,600 a year. You got your money back in less than a year. And then you have the 29 years left of saving that money. Okay, and another thing, this is just a last nugget I'm going to tell you guys. Whenever you refinance, okay, anytime you refinance your home, if you cannot convince yourself into thinking or believing that it's a good savings, do the math. Give yourself the scenario. You can get an app, an amortization app on your phone, and plug in your scenario right now without refinancing. If you were to stay where you're at today with your current home loan, look at your total interest paid at the end of your 30 years of not refinancing. Then take your new or proposed scenario along with your increase in rate or your increase in loan amount, plug those numbers in the amortization schedule, and then see how much total interest you would be paying. And then you compare those two together and see which one's gonna save you the most money. And not only that, take your proposed loan, your new proposed loan, take the savings you would be saving monthly versus what you currently have now, and add it as an additional payment and see how much more money you could save. And then at that point, you should be able to recognize the actual true savings. Remember, as I say in all my videos, you guys, math doesn't lie. Math doesn't lie, okay? plug in your current scenario versus your proposed scenario, see where you could save the most money. At the end of the day, it's all about how much money you can keep, not what you make. All right, especially on your biggest investment, which is your home. Hey, you guys, I hope you guys like this video. I hope this helps somebody out there. I just like to help people. If you guys have any other questions, post it down below. I'm also going to put a link of my email down below. If you like this video and you want to keep hearing my videos, click like and subscribe. Hit that thumbs up button. And there's a notification bell somewhere around here. And go ahead and click that as well to notify you every time I drop a video. You guys have a safe and blessed week. God bless each and every single one of you guys. And I will talk to you guys soon. Peace.